There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to help give us the details from today's session. I'm going to start with the major averages, which ended in the green here. The Dow had a bit of a rocky start, but really we saw stocks take off once we got the job opening and labor turnover survey, JOLTS as we like to call it, which showed a higher number of openings than had been anticipated. Now, as we know, there's been a lot of concern in the market and questions about when we are going to start to see the tariffs have an effect on economic data. We talked to Joe Brusuelas of RSM earlier, the economist there, and he said we're not going to start to see it, perhaps the effect from tariffs on prices, say, perhaps until July, and start to look for job effect sometime around then as well. So all of this is seeming reassuring to the market. The Dow gaining 214 points here, a little better than 0.5%. The S&P 500 up about the same amount, and the NASDAQ leading gains today, finishing just off the highs, up 0.9%. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. I believe that's lucky number 4, up 4 days in a row for the Dow. There you go. And it's been a kind of a rocky road here. Just want to show you the NASDAQ real quickly. Here is a 2-month view. We have been trading sideways, and we are just barely breaking out of this range today. It's more pronounced in certain markets, and you can see that in NVIDIA. We'll see if we have time for that in a second. XLK, that's the tech sector. By the way, XLK is leading today, has led. That was up 1.5%, and then energy in second place, up about 1.15%. Then you got materials and industrials after that. Real estate, communication services, and staples, those were the 3 underdogs, those in the red today. But let me just show you what's going on with tech here. Here's another 2-month chart. There are the candlesticks. And again, you kind of got to squint here, but we have broken to the upside. And if we take a look at the NASDAQ, we can see some outperformance by NVIDIA. Look at that. It's in the upper left. So that means it is the biggest stock in the known world here. $3.444 trillion worth for NVIDIA. And let's just see what that looks like. That is broken to the upside as well. So NVIDIA leading a bunch of markets higher. I'm going to put the percentages back on here. You can see Amazon, Alphabet, Meta took a tumble today. Broadcom just notched a new record. That was its first record in some time here on a closing basis, I believe. And that's a 1-year chart, and it's kind of it looks like a V bottom there, along with the rest of the market. So score another one for Broadcom. We'll take a quick look at the Dow, and we can see a little bit of red smattered through out there. We've got some staples down, but for the most part, a risk-on day and some promising breakouts, Josh.
All right, Jared. For more on the latest market action, let's get to CEO of Genter Capital Management. That would be Dan Genter, along with Aristotle Pacific Managing Director and Portfolio Manager Jeff Klingelhofer. Gentlemen, welcome both of you to the show. Dan, I'll start with you. Markets higher again today, green across the screen. The SPX, the S&P 500, Dan, we're right near record highs again. Are you surprised by the resilience of the market, Dan?
No, not really. I think that what you had is that, the market will always take good news or bad news. It just doesn't like no news. And that's what we were dealing with for the last 6 to 8 weeks, is that with the tariff overhang, no one really was able to decipher exactly the direction we're going. So I think that we're seeing that, we're seeing a much more sanguine environment where people are realizing that the president is likely or more likely than not to get these deals done. When the deals get done, they're 100% going to be at least more in favor of the U.S. And people are now beginning to look at this is not going to be as much of a albatross around their neck, and starting to get back to market fundamentals. And market fundamentals are actually pretty good. We're trading about 5% cheaper at 21.4 PE than we were at the beginning of the year. The earnings have come down a little bit in estimates. We're still looking at about an 8% increase. And so if you just track earnings and even have no multiple expansion with the dividend, it's an 8-9% type of environment. And that's going to be at least a crosswind, if not a little bit of a tailwind as we go forward. And the market's recognizing that.
Jeff, stereotypically, fixed income folks tend to look at the glass a little more as half empty instead of half full. So I'm curious if you have sort of the same interpretation of the sentiment right now around the data and around the sort of policy framework that we're seeing.
Yeah, I think there's positives and negatives. I mean, you're absolutely right. We tend to look at the downside a little bit more. But what I would say is there's a lot of noise around tariffs. We still don't really know the real crux of what's likely to come. I think we know the direction of travel, and that is that the tariffs are absolutely increasing. They're going to be attacks. And the question is if they're attacks on the consumer, and if they are attacks on that consumer, I have significant questions of whether the consumer really has the ability to absorb those price hikes. But the flip side that we're not talking about from a market's perspective yet is Donald Trump and Walmart got in a Twitter spat a couple of weekends ago, whether who would absorb the prices of those tariffs, whether Walmart would be able to pass increased prices on to their end customers. And I think there's going to be a lot of companies that are ultimately forced to eat those tariffs. We're likely to see margins come down. And so my question is whether we're likely to see softness in Main Street or softness in Wall Street, given where multiples are.
Dan, I'm curious, when you said fundamentals look good and earnings solid, valuations attractive, what, Dan, would be, the risks you would point out? What would be on your wall of worries?
Well, look, I think as Jeff just pointed out, I mean, the jury is still out, and maybe we have 10 votes in, but we still have the other 2 that we don't know if that's going to end up in a hung jury with regards to these tariffs. And so if we have a big surprise, if we can't get China to the table, look, Mexico, Canada, 2 biggest trading partners are done. We'll get it done with the EU. China is, with regards to their supply chain and basic production, is still the one, again, where the jury is still out. So if we have a blow up in that, it's going to be negative for the market. If you have a bump up in inflation, which I think we'd probably all agree is unlikely to show up for at least 2 to 3 months in the numbers, especially with the numbers that are going to fall off, then the market's not going to like that. And if you get any inkling coming out of the Fed that not only are we going to hold pat, but we might even look at raising, we're not hearing that. But, those things are going to be negative. Other than that, we're probably going to see, and I would agree with Jeff from the standpoint that if 10% tariffs stick, which they, above all else, that's probably what's going to happen. It's probably going to get split 3 ways, is that basically producers are going to eat 3%. You're going to have distributors and importers eat 3%, and the consumer may have to eat 3%. And it'll get spread out, probably over the next 90 days.
So, Jeff, what does all of this mean for rates in your world, right? We have seen, and we didn't even really talk, we've been talking about tariffs. We haven't talked as much about the thing that has pushed rates higher, which is these concerns over the deficit and the tax bill making its way around Washington. So what are you looking for in terms of rates, given all of this that you're considering?
I think rates really are where they're supposed to be. And it's really just the last decade and a half of us becoming accustomed to an incredibly accommodative Fed running rates at 0 that we've had trouble adjusting to. I'd push back against the deficit concerns, right? If I look at a 10-year Treasury trading somewhere right around 4.5%, in an environment where growth is 3% and inflation is 3%, a Fed's permanently on hold until we see a recession. And so that feels about right. And I'd say the exact same thing about Japan. We're not seeing rates rise because of deficit concerns. We're seeing rates rise because the underlying economy is actually much more resilient than we thought maybe it had been. In terms of where rates go from here, I think all eyes are on the Fed and all eyes are on the jobs market. The Fed is not going to engineer this economic cycle. They're going to be reactive. And until we see material strength, the Fed is on hold.
Dan, I'm curious, you're broadly constructive on the market. How does that inform how you want to be positioned here, Dan? What looks attractive?
Well, look, I think there's a number of things that have pulled back in this environment and things that were a little bit left behind that are cheap. I mean, when you begin to really look at the energy sector, which was the best performing sector last year, now it's been in the bottom 3 this year. I think you've got some great stocks like a Phillips 66 or others that are midstream, pay you 4.2% while you wait. Literally as a stock that's trading at about 114, 115 now is a $150 stock. On the same side, on the tech side, I like a few of those that have been left behind. Fortunately, we have a big position in Broadcom, so it's another happy day for us. But even one like a microchip technology it's basically everything that is not AI. But they're in a solid position right now. It's probably a $75, $80 stock. It gives you a little bit of a tech play. It was down 40% before the tariffs even came into play. And then on the financials, I think you have some good companies like Capital One. They were being held down basically by the Discovery deal. That's now behind them. You've got a good $250 to $300 available. So there's things that can be picked up in tech, in finance, energy, even healthcare. So I think it's just become more of a stock picker's market. Again, when you're dealing with a little more of a crosswind environment, then you need to go basically and just do it old school research and dig some of these values out.
All right, gentlemen, we're going to leave it there for now. Thank you both for your time today. Appreciate it.
Thank you.
Well, as Elon Musk makes his full-time return to Tesla, shareholders are calling for a few demands from the company's founder. These include a succession plan as well as requesting that Musk devote a minimum of 40 hours per week to the management of that company. And joining us now for more on this is Brad Lander, government official and New York City controller, which owns over 3 million shares of Tesla. Brad, it's good to see you. So you got a wish list of changes, Brad, you want to see from Mr. Musk and Tesla. What are they? Walk us through it.
Yeah, look, we have raised long-time concerns about governance issues at Tesla because we've long wanted a full-time CEO, pay that reflects a full-time CEO, and a board that actually is exercising independent oversight on behalf of shareholders. So yeah, it's not that complicated. Most boards expect their CEO to work full-time. We want clear time commitments, especially in relationship to any pay plan. We want a clear succession plan because you always need that in a company. It's essential to be bringing up new leadership, not only when your CEO is running 5 other companies and half the government as well. For board members, we need board members who have genuine independence and are actually committed to providing oversight on behalf of shareholders. So we want at least one new independent director, fully independent, not a brother, not a bestie, not a relative, not somebody who's dependent on Musk already. And we want a limit on outside commitments from those board directors.
Brad, as we mentioned, the city has a lot of Tesla shares, right? And you've been agitating, this is not the first time you've agitated for change at Tesla. We talked, in fact, last year about some of these same issues or sort of related issues. Tesla is not necessarily well known for engaging with suggestions like this. So I'm curious, have you heard anything from the company? Have you talked to the company as time has gone on and you've tried to be pushing for some of this?
I mean, over the years, we have had some engagement, and at very early on, I think we reached out for the first time in 2017, there were some modest agreements that the board made. But more recently, no, there has not been good engagement on the part of the board with independent shareholders. Quite the opposite, really, right? They moved it to Texas and changed the bylaws in order to limit their exposure to shareholder derivative lawsuits. And look, if they want to take the company private, Musk, bought Twitter in a private way, X, but I don't think we will be well served if we let the basic model of public markets, of shareholder governance, be eroded. That is what is happening here. So we want a Tesla that has real governance and is building for the future in EVs and in its core business lines. And we want to continue the model of independent shareholder governance that has been the boon for American capital markets for decades, and we should not fritter it away.
Brad, these changes that you want to see or calling for, are you going to put them forward, as a shareholder yourself, forward on a vote at the next Tesla stockholder meeting?
I mean, look, we start with this letter and then we scale up from there, but we're considering all of our options. We want a board that listens to shareholders. That's not too much to ask.
And what about doing anything with your holdings? I believe that you guys have lightened up your Tesla holdings to some extent. Is that in response to some of these concerns?
No, I mean, we're always rebalancing. And of course, we lost a lot of value in Tesla from the start of the year. It's rebounded a little. But what we want, the reason why we engage here is for the long-term value of the company. We think it's important for there to be an American EV manufacturer. We think this is good for shareholders to have a company that is building value for the long term. And long before we look to dump a stock, we try to engage and say, we think there's value in having the shareholder perspective and having independent governance that's independent of management and that's holding management accountable. That's a basic principle for value creation. And that's what we're still engaged in here. If that fails, if we can't get any progress on the things that we're looking at, if they continue to resist shareholder demands, if they double down on the things they've done by moving to Texas and trying to block shareholders out, there may well come a time when we would consider selling the stock, but we're not to that point yet.
I'm curious, Brad, I'm just looking at the chart. Since it went public, Tesla up about 21,000%. When did you all first become shareholders in Tesla?
Oh, early on. We've made a lot of money in Tesla over the years. So, Tesla has been a good stock for New York City retirees, judged over the past 5 years since we've held it. And that's why we're trying to insist on these changes. We want it to be a good stock for the next 5 years to come.
Brad, I would be remiss if I didn't acknowledge that you are running for mayor of New York City. I was looking at the recent poll numbers, and it looks like right now you're in third place. Assuming that you are not the nominee, which it looks like right now, if we acknowledge the polls that we're seeing, what do you hope to accomplish even in running the race here? What is sort of the thing that you want to bring to the fore that you want New Yorkers to be more aware of, for example?
I mean, the only poll that matters is the one on election day, and this is a three-way race right now, and I'm optimistic about winning it. New Yorkers want someone who's going to bring honest leadership and get rid of the corruption we've had in the Eric Adams era, and I don't think Andrew Cuomo is the person to do that. They want someone with real solutions on the affordability crisis and on public safety. And they want someone with a real track record of experience making city government run better. That's what I know how to do from the controller's office. I've got real solutions on affordable housing, on public safety, and on making government run better and cleaning up the corruption. That's why I'm running, and that's what I really look forward to doing as mayor.
Brad, great to have you on the show today. Thanks so much for your time.
Thank you.
Coming up, we're going to get you the latest earnings results from Crowdstrike as well as Hewlett Packard Enterprise. Stick around, much more market domination overtime. That's coming right up. Hewlett Packard Enterprise just out right now with their latest earnings results. Let's dive right into those numbers. Shares rising here. Q2 adjusted EPS clocking in at 38 cents. She was at 33 cents. Revenue $7.63 billion. Analysts had penciled in $7.46 billion. Looking ahead, it looks like we're looking for Q3 net revenue $8.2 to $8.5 billion. The street was at $8.19 billion. And it looks like we're now calling for adjusted full year EPS. The range they're given here is 178 to 190. They had seen 170 to 190. This stock, which had a tough first start to 2025, it was down about 20% heading into this print, but we're tacking on about 3% here in the after hours, Julie.
Yeah, and the CEO Antonio Neri speaking in the statement here, talking about the dynamic macro environment here, and the CFO Marie Myers talking about server, intelligent edge, hybrid cloud, all performing well, and not only performing well, but improving margin performance over the course of the quarter here, so that definitely helping matters as well. It sounds like the company says the impact of tariffs will be less than it had previously anticipated, and so that's also helping matters. And those shares are getting a boost of about 3% in the after hours as on the result of all of this.
Yeah, it's always another good, what this really gives investors is another good look into sort of the broader health and resilience of AI infrastructure investment. So it's always interesting to hear what Mr. Neri has to say about that. And good news, Julie Hyman, we're going to hear from CEO, HPE CEO, that is, Antonio Neri. That is tomorrow in the 3 p.m. hour, so stay tuned.
Wait for that. Let's also talk about CrowdStrike here. That company's first quarter revenue coming out pretty much in line with estimates, adjusted earnings per share beating estimates. It is the second quarter, maybe the second quarter outlook that's responsible for the drop, although the outlook I'm seeing is not necessarily bad. It looks like it's the sales outlook perhaps that's responsible for the drop. The sales outlook for the second quarter, $1.14 billion to $1.15 billion. Analysts on average had been looking for $1.16 billion, but the company's earnings per share outlook leaves it room to beat estimates. It's looking for 82 to 84 cents. Analysts had been looking for the lower end of that, 82 cents. So it looks like it's the sales forecast that is disappointing for investors.
Yeah, and also, expectations, you could argue, were elevated going into this print, Julie. And the stock was up around 40% heading into
it was actually at it touched a record in today's session.
You wonder if some of that's going on today. I mean, this is one of those analysts who cover them. You'll often hear about them. They'll talk about as sort of, in their opinion, one of the best positioned platforms, at least over the long term. Dan Eisler Wedbush actually just raised his target. I think it was this week to 525 on that one. I think he calls it the Saquon of cyber. Yeah, nice nod. Of course, the great Saquon Barkley.
Of course, he has good names for everything.
He does.
Doesn't he? Yes. As markets parse Fed policy, inflation data, geopolitical shifts, the U.S. dollar's direction is sending signals investors can't afford to ignore. Joining us now to break down why the dollar matters and what's driving recent moves is Elias Haddad, Vice President and Senior Market Strategist at Brown Brothers Harriman. BBH has $72 billion in assets under management. Thank you so much for being here. There has been sort of increased attention on the dollar, I think it's fair to say, this year, both from a markets perspective and from sort of the DC perspective, and talk about the dollar here. We have seen a little more relief on the rate side of the equation in the Treasury market. What are you watching most closely when it comes to the U.S. dollar and where we're going from here?
Yeah, well, thank you very much, Julie and Josh, for having me on your program. Great to be here. With respect to the dollar, right now what we're seeing is a little bit of a relief rally, technical relief rally. I mean, remember, the US dollar yesterday almost hit a 3-year low. So this technical relief rally that we're seeing probably has a little bit more leg, considering that technical conditions are quite extreme and positioning on the US dollar is quite short. But I think the fundamental downtrend that started year to date on the US dollar is intact for 3 reasons. First, I look at in the US economy, and there's, I think, a heightened risk that the economy enters a period of stagflation. Just look at the tariffs. I mean, the tariffs, I think the average overall tariff rate in the US is expected to increase to just north of 15%. So that would be the highest tariff rate since 1938. And that's up just over almost 13 percentage point year to date. So I think this protectionist trade policies in the US is a downside risk to growth and an upside risk to US inflation. The second reason I think the downtrend in the dollar is intact is that the Trump administration implicitly welcomes a weaker US dollar, especially against the Asian currency like the renminbi, for instance, because this could help probably correct some of the massive trade imbalances between the US and China. And finally, and that's the more concerning part with respect to the dollar, and probably explains some of the unusual correlation we've seen in the market lately, is that there's been a loss of confidence in U.S. trade, security, and fiscal policies. And I think this is best reflected when you look at the trend in the U.S. dollar and interest rate differentials, right? The US dollar has been edging lower lately, whereas interest rate differentials have moved in favor of the US. And this divergence between the dollar and rate differentials, I think, is a signal of a loss of confidence in US policy, and also could accelerate this de-dollarization theme that's been underway for the US dollar since the beginning of the millennium.
Elias, when it comes to the dollar, I'm just curious. I think I heard you mention it briefly there, but how are hedge funds, asset managers, other traders positioned right now, Elias? Did you say they're positioned for more of a decline in the dollar?
Well, I mean, if you look at speculators positioning on the Chicago Board of Trade, they're quite positioned almost extremely short the U.S. dollar. So we could see a bit of a short covering if this relief rally gets a little bit more momentum. And I think I looked at the last Bank of America's fund manager survey. And also, I think positioning on the dollar is at extreme. But to me, this is just a technical. These are technical factors that doesn't really change the fundamental backdrop for the dollar, and that is that the outlook is not too rosy at this stage.
And finally, you were talking about a lot of the trade back and forth. One other item I wanted to ask you about is a provision in the tax bill, the proposed tax bill. It's called Section 899, and it basically looks at countries that the U.S. says have discriminatory tax policies, and then imposes a tax on investors from those countries. Does that have a direct dollar effect as well, if it does indeed make it through?
Oh, big time. It's great you point this out. I mean, this Section 899 of this House bill that would impose the taxes on foreign investors that countries on countries that are deemed to have unfair tax practices. This would actually deter foreign investment in U.S. assets at a time when the country actually faces increasing reliance on foreign capital to finance its ballooning debt. So, this is it was a big red flag in this one big, beautiful act. And we'll have to see if the Senate keeps it, and if this section of the bill, does that is presently written takes effect. Stay tuned, but that's something to keep an eye on. So good, it's very good that you pointed it out, Julie.
And we'll keep an eye on it to see if it does indeed make it through. Elias, thank you so much for being here. I appreciate it.
My pleasure. Thank you.
Public companies are increasing their Bitcoin exposure and now hold more than 3% of all Bitcoins in circulation. That's according to analysis from Bernstein Research. They say imitation is flattery, and if this trend comes on the heels of the business software company Strategist crypto buying, of course. To explain more about who's buying crypto and why, senior reporter David Hollerth is joining us now. So everybody's trying to follow the Michael Saylor playbook now.
Yeah, exactly. I mean, why wouldn't you, seeing the rise in Bitcoin at this point? And, it's an interesting dynamic. There's a premium between Strategies market cap and the amount of Bitcoins it holds. And other companies that have done this, even this year, have also seen that, but not all of them have. So in some sense, the investors that are putting money into this, or the companies themselves, are kind of it's seemingly magically creating money. So that's obviously an interesting dynamic from just an overall markets perspective. And we're paying a lot of attention to the companies, and we've seen a little bit of investor limits to this trend last week. GameStop and the president's namesake media company both reported doing these kind of strategies, and or at least plans to, and their stocks dropped on the day. So it's kind of an interesting trend to pay attention to.
Right, and we've seen strategies sometimes on individual days drop when it says it's sort of raising capital, if investors view that as dilutive, whatever they're doing. But you mentioned that premium, which is the thing that I guess other companies that are doing this are chasing, right? They want to get that to trade even better than Bitcoin has. What have you gotten in terms of explanations of why Strategy trades at that premium to Bitcoin?
Yeah, that's a good question. I think it has to do with the fact that they take on a fair amount of leverage by issuing debt. And then on top of that, it's some sort of forward indication about the price of Bitcoin and how well Strategy and Michael Saylor are going to continue to accumulate it in the future. That's the best explanation I have. But if you look at a financial or an economics textbook, you're not going to get a clear answer like that. So.
No, nor are you for Bitcoin in general, I suppose.
David, while we have you, some breaking news on your very beat, Wells Fargo. What's the latest there?
Yeah, so a key growth restriction, probably the most onerous thing that can happen to a large federally chartered bank, was removed. This was a part of a 2018 consent order. Now, the consent order is still in place, but this growth restriction, which basically held them from growing their assets above a 2017 level, is now gone. So effectively, the bank is out of the penalty box. And that's a big deal because it goes back to this fake account scandal that happened kind of through the mid-2010s. And the fact that regulators, their overseers, are okay with what Wells Fargo is doing now and feels like they've moved past that is a huge sign for the bank and its CEO, Charlie Scharf.
So what is Wells Fargo now, in theory, allowed to do that it wasn't allowed to do under some of these restrictions?
Right. So acquisitions, growing their loans, buying more securities, anything really that that you can think of in terms of growing the business. So it's pretty big. It also means that they can do a lot more with trading if they're interested in that, because that's a capital-heavy business. Banks obviously have to carry a lot of capital to reserves. So to do something like trading, they need a lot more assets.
David, great to have you here on set, as always. Thank you, sir. Well, time now for What to Watch Wednesday, June 4th. Going to start off with earnings. We're going to hear more from value retailers. Dollar Tree reporting quarterly results before the markets open, and Five Below set to report after the market close. Dollar General already setting an optimistic tone as the discount retailer did top earnings estimates and raised its annual guidance.
Database management company MongoDB also reporting first quarter results on Wednesday. That stock struggling with gains so far this year as it leads up to its latest results. And the IPO market back in the spotlight. Circle expected to go public. The stablecoin issuer and some of its backers now offering 32 million shares at a range of $27 to $28 a share, according to a filing. This is an increase from the previous offering of 24 million shares at a range of $24 to $26.
And on the economic front, the latest ADP National Employment Report expected to release Wednesday morning. Economists to get a closer look at the change in U.S. private employment expectations set for private employers to have added 112,000 jobs in May. This would be an increase from the jobs added in April.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.